Well, good afternoon, everyone. As Alex sort of prefaced, we're going to be talking about fundraising. Some of you may be like, wait, didn't we talk about this yesterday on the same stage? And we did. But yesterday we heard from 3 founders who had just gone through the process and were sort of thinking about their next raise. And now we get to hear the VC side of the story. And as Alex mentioned, and as we've kind of been running throughout the day, this is an open Q&A. These 3 VCs have agreed to let me hold them hostage for the next 40 minutes. So please submit any questions you want to hear from them, anything you think we may not cover. We definitely want this to be sort of a resource. So definitely feel free to reach out. But something I think would be good to get started with is, I know when you think about pitching, you think about raising money, a lot of the focus comes down to the pitch, which makes sense. That's when you're getting FaceTime with investors. That's sort of when you're getting the feedback and you're getting the information on whether or not it's a good fit for them. But something we all talked about when we were prepping for this is that stuff happens before that. And there's some information that would be good to get from founders even before they come into that formal pitch session. So I think that actually might be the best place to get started. Thinking before the pitch, what are you guys looking for, and sort of what is helpful to get from founders before you even meet them for the first time? I don't know if Annie, you want to start?
Sure, happy to. Hi, everyone. Thanks for being here. In terms of what to share before the actual pitch meeting, I think we see a broad range from the founders that we connect with. Some people share a deck, some people share virtually nothing at all and just get a warm introduction. We were talking before this about how helpful it is when founders do share a deck in advance. I've always found that it just makes for a much richer discussion when we do have that pitch meeting. I found at times founders have felt like the deck that they worked so hard on and spent many hours getting perfect before the pitch meeting, feel like that's something they want to kind of hold off on sharing and wait until the actual pitch itself to walk through the deck. And I've just found it so helpful as a VC to be able to see it in advance and really think through, going through all of this, all the areas that we look for in an investment, market, founders, product, traction, all of these things. It's just helpful to walk through those materials in advance so that you can say, actually, these are the areas that I want to spend our 30 or 45 minutes together really diving into, so that you as the founder don't have to repeat yourself 12 times a day as you're meeting investors, and it can instead focus on whatever that one investor may want to drill down on and get a better sense of what might be holding them back from an investment or what they're most excited about. So I always recommend that founders, if they're comfortable, share the deck in advance. I just think it makes for a much richer conversation.
I totally agree. And I know that sometimes, I think what Annie was referring to, you might feel a little uncomfortable sharing all of that information in advance. And so what I generally recommend is having almost like a teaser version of the deck where you have enough data and enough information to give us a sense of where are you in terms of the journey of your company, a little bit of information about your team, and just enough information so that we come prepared to the meeting. And what I also recommend is make sure all the slides in the deck aren't ones that require a voiceover. So leave the voiceover slides to what you might present in a formal pitch, and that's ahead of time. Another thing I really recommend is for products that need to be seen and that you can actually trial ahead of time. So like an app, for example, that I can download, but actually something that requires me to go through a sales process or whatever it might be, have a product demo, send like a quick video so that, again, we have a much better sense of what your product is and what you've built to date, and we can come prepared to the meeting.
Yeah, I mean, no surprise, I completely agree. I would say in terms of etiquette, the way you get introduced, I would say send an email with a blurb about your company, and then, yes, a teaser deck or the full deck if you wish. For folks who don't send that, I actually generally don't even meet with them, because I say, hey, there could be a conflict in my portfolio. I don't want to I don't want to waste your time unless I can learn a little bit more about the company first. And then, if I know more about the company, it actually can be a really effective use of time that we can just dive right into questions I might have about the company, because I will have looked at the deck beforehand. So I find that to be the best way to go from my perspective. And then, yeah, Jomayra, I think a demo, if there is a product to demo, there's amazing pitches I've had that were just really led with the demo. If you look up Dylan's seed pitch deck at Figma, there's a great one on YouTube where he just talks about the problem loosely for a few minutes, and demoing a product and getting people to love the product.
What should founders be prepared to answer?
I think I'm happy to go team. So kind of your story, journey to date, what got you excited to build this company, talk about, strengths and weaknesses across the leadership team, who you plan to add to the team, post a raise, then dynamics in the market. How do you think about where you sit in the market? What have you done in terms of customer discovery? And then come up on a case-by-case basis that maybe are related to the fundraise.
At the beginning, but I think sometimes founders may not spend as much time on it as if you're looking at a seed investment in particular, but just as true at Series A. What is your kind of learned insight or unique insight on the space that you're tackling around why this is worth doing? Like, why is this a venture worth pursuing? Why should we get on board with you and say, like, let's go build this thing together and put, everything on the line to be able to build this future. I think sometimes founders will say, yeah, I worked in the space before and I thought this was a problem, and so here I'm solving this problem, and that's great. But I think the times that I've really leaned in and said, wow, this is a founder I need to work with, is when that story is just so compelling that I'm like, yes, this person, this is to just say, this is my life's work, and you should be on board with this because we're going to build something huge together. I think it's just an area founders should spend more time.
Totally. That's almost always the first question I ask. I think I probably heard someone else say this, but there's a bunch of T's. So team, is this the right team to solve the problem? TAM, is there a big enough market where if you really succeed, it's going to be a multi-billion-dollar outcome? Traction, have you achieved some sort of meaningful traction? Or if not, are the framework by which some investors use to gauge an investment? And I think
really catches founders off guard, or maybe a question you think a lot of founders aren't particularly prepared to answer when they come to the meeting.
Go ahead. I always ask at the end, what questions did I not ask in this pitch? And it almost 9 out of 10 times always catches founders off guard, and they're like, well, I don't know, let me think. And so it's interesting, but I almost always ask because I'm sure there are questions or things that we didn't dig into that they would have liked to.
I'll often ask, what questions do you have for me at the end? Because in a pitch meeting, the founder spends so much time talking, but it's important for us to get to know each other. And I think particularly over Zoom, where you don't get as much of a chance for the small talk on the way into the meeting when you're walking to a conference room or whatever, I try to leave the meat of the conversation. So I'll say, what questions do you have for me? And sometimes founders are like, what are next steps, or what's the process from here, which is fine. But I think if we're going to be long-term partners, if I'm going to join your board, presumably there are other things you may want to know about me as a person or our fund, the way we work with founders, and I like to leave space for that.
Yeah, I think on top of those things, so we're a sector-specific fund investing in fintech, and I'm landscape. If you're starting a company for which there are at least a little bit about what they're doing, what the roadmaps look like. And if you haven't done that homework, that always comes off as not great.
And knowing that this panel is mainly focused on sort of raising your first dollars, especially in the environment we're in now, people are a little more cautious, people are not deploying as much capital as before. Are there anything else as far as questions or sort of information you're looking for specifically now because of this environment, or when you are speaking to someone who is a newer startup just trying to raise that first capital?
I don't think it's changed that much what we're looking for, to be honest. I think pace has slowed pretty much across the board, it seems like. But in terms of what we look for a great new investment, it really, I think, is the same things. If anything, we spend more time, maybe a year ago, it was looking more at just simply growth and what's that growth. We've always said, okay, that's revenue, let's kind of click down and look further down the P&L for unit economics and whether this is really a good business. But I think that latter part has become more of the focus, whereas last year you probably could raise a solid round just on the revenue trajectory of the company. And this year, people are a bit more discerning to say, okay, well, if that revenue is at 10% margin, we should take that into account seriously. Or, if you've scaled headcount such that you're burning $10 million a year at an early stage, that's probably going to be a problem. So I think it's the same core things we're looking for in team, market, all these things we've talked about earlier, but maybe more of a focus on unit economics than just pure growth, which we saw the last 2 years.
Yeah, completely the same. I do think there's probably more questions this year on, unit economics. I think there's probably
about what do you need for the next 18 to 24 months to hit the milestone. And so I would say if there's one big change, that's probably one of the biggest ones when we think about pulling together a round for a company.
Yeah.
And I know one of the big aspects of fundraising is nuance. You can't pitch every investor the same way. You don't pitch every round the same way. It just wouldn't make sense. Investors are looking for different things. And something that I think was interesting is knowing that some of us on this panel are generalist investors, some of us are more in sort of sector-specific funds. I'm curious, how much do you want founders to sort of talk about the niche of what they're trying to get into, or sort of explain the market they're trying to tackle when you are a fund specialized in that broader category? I don't know if you guys want to start.
Yeah, I think when you're working with a sector-specific fund, you should assume they know a lot about the category already, and if they don't, then they're probably not a good fit, or probably not, probably not the right partner. So I think it's really sort of level setting, or sort of like changing your pitch based on what somebody might already know. A lot of things that I found effective people use are talking about context of other companies in my portfolio. It shows that they know the portfolio. They look up to a particular company. They describe themselves as like.
Yeah, so we're a fund that focuses on education and the future of work. And for us, what we really look for is self-awareness. And are they experts in the category? And we think about that as value add. But you should do this. We do know X competitors are in this space, and this is what we know about, don't know, and being open to learning. That's generally what we look for.
And now, Annie, thinking that you were at this big fund, how much should founders dive into the market and the niche of what they're trying to do when they're pitching someone like Kleiner?
I actually think it's pretty similar to both our 5 key buckets, but within the fund and within our team, we have areas where we spend more or less time. We talk about them as our majors and our minors. For me, I spend the bulk of my time in healthcare, both B2B and B2C, and consumer tech. And so anything in those areas, I spend a lot of my time, and so it would be not too dissimilar from pitching an ed tech fund or a fintech fund in those areas. And then if you're an ed tech focused company, we'll find the right partner for you. If you're a fintech focused company, we'll find the right partner for you. So we have a lot of latitude in terms of where we spend our time, but tend to have focus areas within that makes it easier to kind of sift through all of the companies that we're seeing and find the perfect person or partner for you to meet with, depending on what you're pitching.
Mm-hmm. And sort of looking at the other side of this, what are some things in the pitch or some things about how the founder pitches or how it sounds pretty good on paper or looks good with the numbers?
My biggest red flag is what I just call hand waviness, which is you ask a question and it's a good question, and we know historically it's hard to sell into X, Y, and Z customer, and they say, oh, well, we've already sold into these 10 customers, we're gonna leverage our networks and we're gonna continue to grow. That's a hand wavy answer, right? It's not actually talking about a strategy. And so I find that to be a really big red flag, because it just shows a lack of critical thinking and also a lack of, I don't want to say integrity, but it shows that if in the pitch you're kind of hand wavy, I imagine in board meetings you'll probably be hand wavy, and when you're talking with your own employees you'll probably be hand wavy. And so for me it's a yellow /
competitive slide and say either we actually don't have any competition, we're creating this market, or these are our competitors, but they're all bad. And that's simply never the case, like in every sector that we spend time in. And often it may not even be competitors that you think of as a direct competitor, but it's a competitor for your attention, or spending time with your family, or literally any other activity. And so how are you competing is undervalued or underfocused on relative to other things. And we think a lot about it because it's a competitive market and it's hard to acquire customers in this environment. So. Yeah,
there's always the check boxes. There's like the square, the matrix of your competitors, and you check every box and your competitors don't, but that checklist may not be the checklist that actual customers use, and it almost probably never is that same checklist. So that's always a fun one. I'd say another one that always trips me up is like bullshit metrics. Like there's certain things that don't really matter to the business that people celebrate in their deck. Our best companies were so lean,
yes,
and a very small team got to $15 million in revenue.
Sort of trimmed down so you can kind of get to the real conversation.
Sometimes I would say market. I would say probably particularly in a space that you feel like you know really well. And again, this is one benefit of sharing the deck in advance. So I've joined meetings where I've seen the deck in advance and done intros and whatnot, and then said, by the way, like I've spent a lot of time in this space, know this market decently well. Like you don't need to walk me through the 6 slides on why this is a big market, why this area is interesting. I kind of get that. And let's move on to like why you are uniquely differentiated, what your approach is to the problem. I think that's one.
Yeah.
I think that's the biggest one for me. Although I did like last week have a pitch with somebody who spent more than half of the meeting talking about himself only, like before he got into the company. People really go overboard there.
Yeah, I think my biggest feedback is just be adaptable, because I think investors also have to take a little bit of charge and driving, understand a market, or you may not know the depth to which we understand something. And so if we're like, oh, okay, yeah, no, totally get it, we can skip over that, be flexible and adaptable to that, and the conversation too.
And something I know that came up yesterday when talking or is in this business and sort of why they're in that market and why they think it can succeed. And I'm definitely curious to get your take on that. Like, how should founders strike the balance between sort of the story and the numbers?
I'd say
Go ahead.
at Seed, the stage we play, it's really much more the vision than it is the numbers. Like, we could dive into the CAC or LTV, but it's out. It's really much more a vision pitch, generally speaking, at the stage that we play.
Yeah, I totally agree. And live and synchronous times, those are the times in which telling the story and the vision is a lot more compelling, and reading it is not the same, versus the numbers. Reading it and synchronous is almost exactly the same, though there might be some level of nuance, and that's why we'll take some time in the pitch to discuss that. But if you're deciding which one to prioritize, the vision and the story is just so important, because you can't really recreate that on an email.
I think that trajectory, it's more, show me the numbers. Like you raised $25 million last year. Like, let's show you the snapshot, and then we have a data room, we have a deeper, so I still think it's, more on the vision, more on high level in the initial pitch, but it does change over the course of the life cycle.
Yeah, and there's a difference between the first meeting versus the third or fourth meeting you have with the person, right? Like, it's going to evolve over time, and so you have to be aware of that too.
Mm-hmm. And something else I found interesting that not only came up on the panel yesterday, but it's actually since come up on multiple panels I've sat in on today, is the concept of how you reach out to investors to begin with. Maybe if you don't have an existing relationship, and something the panel talked a lot about yesterday is utilizing Twitter, and utilizing Twitter to sort of make those connections, as well as just posting about the company and generating like organic hype around it from investors, even when you're not reaching out to ask to raise. And I'm curious sort of how you guys approach the concept of not necessarily fundraising through Twitter, but how you feel about founders using it as a tool in that way, and sort of how you would feel if founders were kind of reaching out to you through that platform.
Great. Like, we've invested in 2 companies that 99% of people do it very poorly. And so then like my DMs become a cesspool that I don't even want to look at. And so they like, I'd love to grab 15 minutes of your time. Like, I need to know what you're doing. Like, tell me what you want from me first. And I would say like those 2 things, like knowing what I invest in and sending me a message like about what you do, like a quick blurb, can give me a sense of whether I'm going to be interested enough to dig in. And then I'll share my email address and we'll schedule time. Totally fine.
I totally agree. Just do your research ahead of time and do something nuanced. Also, if you copy and paste stuff, make sure you change the name, please. I can't tell you how many times I've been called John Steve or something along those lines. I'm like, not me. Or I get someone else like, I've heard like ENIAC does this. I've heard like Kleiner does this. I'm like, cool, let me forward this along. Be responsive. If you don't hear a response, also know that like most of our DMs are just like completely flooded, and maybe email is another approach that you can take. And most of our, at least I know my email is on every article I've ever written, so you can find it pretty easily if you search.
My bad Twitter story is that I actually also went through the process, ended up investing, and the founder was like, by the way, I DM'd you on Twitter like 3 months ago, and you didn't respond. And I felt horrible. I mean, I'm glad I ended up getting connected. I went back and read the Twitter DM, and it was a great message. Yeah. But I do get a lot of Twitter DMs from not even, I don't think, the tech or startup ecosystem. I don't know
yeah.
how, the Twitter scams, the whatever. So my DMs are a bit of a disaster.
Totally.
So I totally missed it.
Yeah.
And now, since then, that was last year, I'm like, I need to stay on top of my Twitter DMs. You never know, my next investment may come through there. But I didn't realize it at the time. So.
But also
Or company Twitter better for the cold DM?
personal.
Personal.
Oh, personal.
Yeah.
I have no idea who owns our company one.
Knowing that, reading the headlines about sort of how this year has gone for startups, rounds are structured and sort of some founders feel they're being asked to dilute more than they wanted to, especially raising some of those really early rounds. And something that we talked a little bit about yesterday with the founders is sort of how do you approach equity with when you're talking with these potential investors?
In general, in your first round of financing, like just rule of thumb, expect anywhere between 20 to sometimes 30% dilution. That's probably the right range. Anything below or above that, like starts to go, out of the margins, but that's generally the right range. In terms of thinking about, the term sheet, what the right price is, obviously, like you don't want to create the company, but you also don't want to be so protected, only amount of dilution will take, because then you risk actually not getting any funding at all.
It's gotten to be a tougher market. Well, like, if we revert back to, let's say the last 2 years were an aberration in terms of valuations, and we're reverting back to 2019, engineering salaries haven't reverted back, and inflation has happened. So I think there is some element of the last couple of years where like throwing resources at every problem, and resources being capital. And I think the next few years are going to be a lot harder, and there will be less resources, and many of the best companies start during these times, as you guys know, but that has changed. So, if you think you need a $5 million seed round, like that very well may be the case, but I might ask you I might suggest a smaller round. And that has happened, and actually in many cases worked out quite well.
I've been surprised. I occasionally will meet a founder where they'll say, at seed, we're raising 4 at 20 post, and we're looking for a lead. And you're like, well, then how do you know it's at 20 post if you're looking for a lead?
Exactly.
So the other thing is you can determine and make a plan for like, we think this is the amount of capital we need to raise to get to the next set of milestones. And so, we're raising 4 million or whatever the number is. But it's strange a bit if you don't already have a term sheet with a price to say, this is the price that we've decided makes sense. I think that may not set you up for success if there are investors who are like, wow, this company is really interesting, but it's super early, so I would maybe do that round at 15 posts, but like I'm not going to do it at 20 or 30 or whatever number you chose. So I would be a little bit hesitant to share what you think the terms are without the investors saying this is what I'll pay.
Also, generally, it's a good idea to go out to market raising less than trying to raise more, because the market can always pull you up to more, right? Like, if you go out and you say, I'm raising 5 million, and then you get a bunch of no's because folks are like, you don't really need 5 million, like that's actually too much for the stage that you're at, you very rarely get another bite at that apple. A no is really hard to turn into a yes. But if instead you go out raising 3, you get a bunch of interest, and actually there's a ton of people that want to be part of the round, then maybe you can actually get to 5. So general rule of thumb is like go out for less and let the market push you up if there's enough competition for it.
One thing I would caution you against, and I agree with Jomayra, 20 to 30% I think is standard, is too over-diluted companies that we have seen, and we tend to stay away from personally. But like, if it comes into a situation where a founder after a seed round, there's a couple founders, a lot of dilution along the way, founders only have 20%, I'm thinking about, well, I'm going to need to top that founder up in the next couple of rounds. Like, how much more dilution is for that for me? I don't want to deal with the conversation. Like, let me just pass on it. So you don't want to be over diluted either.
Yes.
And turning to some of the great questions we've been getting from the audience, one that came through, what advice do you give for the founders that maybe aren't like that? They aren't out.
And they've actually beat out their competitors just by being solid operators and executing on their plan in an incredible way. So I think first of all, don't worry, you can build a great business even if you're not, but know that there are a lot of skills that do correlate quite well between being a good, somebody who's good at pitching investors and somebody who's good at running a company. Like recruiting. Recruiting is one of the most important things you do as a CEO. Another important thing you do as a CEO in the early days is certainly pitch customers. So if you are not that person that is going to be able to raise capital, recruit the best talent, and sell to customers, then you probably need somebody else on your team who is. So I would be thinking about that from an early day.
Yeah, and the only thing I'll add is sometimes we equate extroversion and this like charisma and kind of sales persona with someone that is more effective at pitching, but instead, we often talk about just the ability to inspire resources, like people that want to work for you or people that want to advise you. And you don't actually have to be that personality in order to get that. Sometimes that personality is someone that is a little bit more techie and wonky, but they're so passionate and you can tell that they're passionate. They're really smart and they inspire resources. And so we look more for that and less so for the salesy, extroverted type of personality. Not that either one is bad, but or better or good. But there's different types of personalities that have created amazing companies.
We're in the same boat, and I would say especially for super technical products, like one of my partners invests largely in enterprise infrastructure and data infrastructure, and a lot of the founders that come through are very different than some of the founders that we're looking at when looking at a consumer or healthcare investment or some of these other areas. And there, what we're looking for is the technical capabilities, and will this, again, to hiring, will this person be able to hire incredible engineers out of incredible companies and convince them to come work for them? And a lot of engineers are not looking to go work for the big personality sales leader. They're like, I want to work with incredible technical talent. And so you actually may be more effective as a exceptional engineer than if you are more outward facing, more sales oriented. So I think it also depends a bit on the type of company you're looking to build.
Totally.
Mm-hmm. Another good one on here is sort of thinking about how should founders pitch if they are looking to raise funding for a company that maybe is in a crowded category or maybe is at a similar stage or valuation to someone else, like in the very sort of micro sector that they're looking at. How can a founder help themselves sort of stand out when they are pitching something that could be seen maybe as similar?
I think the biggest thing is, what do you know that we don't know or your competitors don't know, right? Like, what is the unique insight? Because you can convince me of that if you have enough kind of evidence or you have like this really, really strong insight, but that would be the biggest thing, is what is that secret that no one else knows that you do?
Mm-hmm. Yeah. Great. Why are you different and why will you win?
Yeah.
It all comes back to the first question you asked, or the question you said you start with, which is like, why are you doing this? Why have you chosen to spend your time doing this when there are a bunch of other companies out there doing the same thing?
Right.
And if you can compel us on why that is, then that's great.
Like, you as the founder aren't dumb. You aren't saying, wow, this space has already been won, this incumbent's going to be impossible to unseat. Like, you've clearly seen something to suggest a new approach is needed, and so you just need to share that with us.
Yeah, and I would say in order to get the introduction, lead with that, because sometimes you'll see investors just quickly look at the deck and be like, there's a million people in this category, I won't even take the meeting. So you kind of have to lead with that and don't make investors kind of work to figure it out.
Like, here's how we're different from the incumbent that you're obviously thinking about when comparing us.
Mm-hmm.
Yeah.
And I think we probably have time for one last question, but I think this one is particularly relevant to the market we're in right now. Someone asked about how should founders approach pitching when you're pitching a capital-intensive business, like a marketplace, or something that is going to look heavy on the cash burn, heavy on sort of the balance sheet side of it, when I know a lot of investors in a market like this are definitely looking for maybe lean, slimmer, like low type of metrics in that area. So how should those founders pitch the more capital-intensive businesses?
I mean, I think kind of going back to the fundamentals that Annie mentioned before, like how do we make sure, because people are still investing in capital intensive business, if one, the market is huge and the outcome can actually be huge if you win it, and two, the actual fundamentals are sound. I think people are still very much open to that. I might also focus your efforts potentially on folks that have a bit more cash or deeper pockets too. It assures you more stability moving forward. But that's how I would kind of frame it.
Yeah, same. I think the challenge has been in the last few years, these capital-intensive businesses have needed a certain amount of capital, and then you kind of work backwards, and the valuation was dictated by the amount of capital they needed. And then you have all these companies that are upside down when they go public, right?
Right.
Like they raise so much capital at crazy valuations that the public markets could not justify. So if it's a capital intensive business, like it probably needs to be priced appropriately for me to be interested. I know that I'm going to take on a lot more dilution than I would have otherwise, even if in many of these cases, the headline number looks really great, but if you dive into it, the returns aren't great.
Right.
So that's something that I think about.
Yeah, I think you just need a clear narrative around your path to profitability, which is like, this is what the unit economics look like today, or this is what it costs to stand up a new market, and here's how we're going to phase our 5 new market launches over the next 2 years. But it's not going to take 10 plus